is Nathan Hammond, and for this final presentation part of the project, I'm doing the mutual funds and how we can see potential growth and what we're going to be seeing down the line as we invest in these funds with our risk score and our risk tolerance. So what we did is I used the first one is the Canara Robeco Income Saver Fund. This fund is located in Mumbai, India, and I felt this was one of the best funds to go for because it had showed good growth, and with our risk score being at 28, I felt that this is a good fund to invest in the long run. So what we would end up doing is be holding onto this fund for 3 years to let it grow out. So as you can see down in the bottom right hand corner of the screen, I have a 1 year, a 3 year, and a 5 year growth rate for this fund. And on the first year, you'll see it's at 6.18%, and in the third year, you'll have 5.20 as it went down, but in the fifth year, it goes back up. So the reason I chose year 3 is because after 3 years, the growth rate would be 5.20%. Now our risk score is we're a medium to high risk score. So we feel that we can take the risk, but we also want to be cautious in the same point. So right now, looking at the 3 year, yes, it has gone down from year 1, but you do not know what's going to happen after once it gets to year 5. It could go down, it could go up. There could be a global situation as there is right now. You just do not know what's going to happen. So the reason is after 3 years, the growth would be 5.20%. We would invest $10,000 into this fund. So what we did is we allocated $20,000 to the funds aspect of this project out of the $100,000 we were given, and we felt that if we invested $10,000 into each fund, we would be able to recoup a lot of money in the end. So what we're going to do is we're going to invest $10,000 in this, and in the long run, we should recoup a good amount of money coming into the end of this. So what's going to happen is, as everyone knows, we have a pandemic going on. So I felt that this will continue to grow once the pandemic is over. So right now, Mumbai, India is currently struggling because there is problems with the coronavirus going on. So it's hard on them with trade, and their stock market is starting to crash. I've been doing research, and at the end of almost every day, their stock market ends in the red, which you never want to be in. So once this pandemic is over, I feel that more money is going to be pushed into their accounts and funds, which will continue to make this grow. So I feel at year 3, once this gets to year 3, I feel that we're going to have a better growth rate, and we would have a higher percentage of income coming in. So as I said, once the pandemic goes over, more money will be spent into this fund. So I found that the dividend for 3 years would be minus 2.80%. And yes, that is not what you want, but I felt that after the 3 year period with a 5.20% growth rate, I feel like we'll still be recouping more money in the end. So as I stated, our risk score is coming in at 28. This is the best fund to invest in for the long run. So on their website, they did say they had a medium risk fund. So I felt that this was one of the best ones to choose. So I also found that the risk is that it could continue to drop due to the U.S. and China tension from the coronavirus outbreak. And so the reason this is a big deal is as the U.S. and China are having troubles with this whole thing right now as the pandemic started, trade is going to be affected from this. And the reason this is a problem is because this could really hurt India if trade is halted, because the U.S. will send products over to China when China will send products over to India. So if this trade is halted, then India is going to be losing a lot of income, and they're not going to be able to bring in products for their customers to buy. So what this could really hurt is it could hurt this fund in a big way, and it could easily drop the growth rate of this fund, which could really hurt us in the long run. So the final fund that I found, and the final fund that I felt was best for this group, is the Axis Gold Fund. So I felt that this was perfect as it sits again at a medium risk score, which is perfect for our risk score. Right now, this fund is about gold. So gold is an entity that people are currently trying to sell due to the low level of money coming in. So people want to get rid of their gold because right now the market is crashing, and people want to put their money out. That people want to start recouping money. So when the market opens back up, they're able to go out and be able to spend more money. So what I found is we would hold in this fund for 1 year. I know that is not a big risk, but what I found is that it deals a 58% fund return. So what we would do again is we would invest $10,000 into this fund to maximize our profit return. And so what would that do is we hold on to this fund for 3 years. I saw that it will drop by 31%. So this fund return would drop to 27% by year 3. So I felt that if we were smart about this, we would pull out at year 1 to get the biggest fund return possible for our group. So even though we have a medium risk tolerance, it would be the best possible situation for us to hold on to it for just 1 year. So as I stated in the last fund, as the pandemic ends, the rise will continue to grow. The rise on the fund will continue to grow. So gold will become more valuable, and jewelry stores will open for customers to sell their gold. So right now, I did see a graph that was too big to put into this PowerPoint, but I did see a graph. Right now, the gold prices are skyrocketing as people are not able to leave their homes. Stores and pawn shops, any place that wants to buy gold, they're not able to because people are not able to leave their houses right now. So the problem is with that is that they're going to raise the price on gold. So the reason after year 1, the future forecast said that once this pandemic is over and people are able to go out, gold is going to be a huge item on the market that people are going to want to sell and stores are going to want to take in. So over the past month, gold has continued to rise as a shortage on it has increased. So once this is over, people are going to start selling their gold, which means our fund is going to rise in the end of this, which means we're going to have a bigger profit in the end. So I felt these 2 funds were the best funds for our group to invest in, and I felt like they could recoup a lot of money in the end once this pandemic is over. So thank you for listening.
I'm Sam Kassane, and my partners are Nathan Hammond and Jalal Johnson. This is the final presentation we have, and I'm doing the stocks portion over it. Before starting the stocks, there's some points to address. Our risk profile as a team is 28, which means we're more moderately aggressive. So with that being said, we're going to take the $100,000 investment and put 50% into fixed investments, 30% into equity investments, and 20% into funds or cash investments. The economic forecast that we are looking at today is that everyone knows the COVID-19 outbreak is happening. It has globally cost us worse than the 2008 financial crisis, and in the US, as you can see in the top graph, that is made the GDP growth downturn from last year from 2.2% to 2% to today. The unemployment rate has dropped from last year, which was at record lows, and is now rising day by day, with businesses having to shut down and as well states. The core inflation has definitely risen a lot more since the 2019 year and looks to see that it will rise in the future. The market efficiency that we're going to see, that we are going to take with the stocks, is that the way the stocks are looking right now is how we think they are going to be. We think that the numbers that they are giving off is why we should invest in them now. So the 2 stocks that we are going to invest in are Amazon and Innovative Industrial Properties. Amazon is selling at $2,317.80 per share. We're going to hope to put $35,000 approximately into it, which would be about 15 shares. For Innovative Industrial Properties, we're going to put which is selling at $77.07 per share. We are hoping to put $15,000 approximately, which would be 196 shares into the company. The first company that we're going to look at is Amazon. What is Amazon? Amazon is an online retail business where you can buy and sell products and have them shipped to your doorstep. As well, Amazon is now opened up and has an online entertainment business just like Netflix and Hulu, where you can watch and buy movies whenever you like. Some key growths for Amazon is that right now in the COVID-19 outbreak, a lot of companies have shut their doors and had to fire people, but for Amazon, they've had to open more doors and hire more people. We see this as a growth because no one is wanting to go outside their house, and especially some states have it to where you cannot go outside your house. So you cannot really go to stores if you're afraid to go outside. So companies like Amazon are booming in sales right now because everyone is buying stuff online. We also see this that in the future, people will see Amazon as more and more helpful and become more lackadaisical to wanting to actually go to the store and just have things shipped to their doorstep. Some key ratios that we are looking at is the price to cash flow, the PE ratio, and the asset turnover. We can see that they are all functioning at a very good positive ratio. especially the asset turnover ratio. You're almost making $1.50 off of revenue for each asset that you make as a company. As well, some key indicators that you might look at is a debt equity ratio is at 63%. That is actually quite high for a company, but Amazon being so big, it's because of their inventory. But even with all their inventory and everywhere they have it, the company is making a positive profit margin, and operating profit margin was at 3.6% and 4.76. Even though when buying stocks, you somewhat want a dividend as an investor because it makes you feel better, but Amazon is yet to give a dividend out. But why do that? Before the coming of the COVID-19 outbreak, the company was at $1,977 per share, and in just 2 months, the company has risen from that price to $2,317.80. A boom in price. That is why we think Amazon would be a great buy for now and in the future. The other company that we are looking at buying stocks in is Innovative Industrial Properties. What is this company? This is a medical cannabis real estate investment trust. It does not just own one company, but owns 35 cannabis properties in 15 different states. Right now, cannabis selling might be a little slow, but in due time, there is going to be tons of opportunities to invest in more companies in more states in the coming years. Just in 2020, Illinois opened up with a recreational sales of marijuana. With it being such a populated state, the sixth populated state, other places could follow in its footsteps. Many activists and some governors have potentially tried to put voting to legalizing marijuana on ballots and stride towards legalization. More states could start to open up the market or lessen laws towards the slow process of legalizing it in the future. What are some key growths that we see? With just being said that Illinois has also opened up, more states could follow in Illinois' footsteps, and we see this as a growth potential for a company like this. More places to buy properties, more money to make. Some key ratios to look at is the price to cash ratio is at 19.08%. The asset turnover ratio is at 0.03, which is not bad, but not good either. The thing is, with some companies, they have high profit ratios, just like this one at 52.56% and low asset turnovers. And in other ways, some other companies usually like to sell with high asset turnover ratios and low profit margins. But both are good, but in different perspectives. Some other things that we could see is that its inventory turnover is at 2.84%, its ROE is at 6.05, and the ROA is at 4.69%. The debt equity ratio is 0.25%, which is very well. And the weird thing about this company is most cannabis stocks do not sell dividends, but this one does at a yield of 5%, which has been an increase of 500% with the company in just the last 3 years. Yes, 500%. And in the last year alone, its dividend is risen 67%, which is very good, especially for investors. If your dividend is to go up every year, more money in your pocket. Now, the target growth we have for both companies is a 2-year goal. All of us, Jalal, Nathan, and me, are juniors, or me, I'm a junior, going to be a senior, but I'm going for my master's degree. I hope that in the next coming 2 years, or by college graduation, we'll be able to sell most or all of these stocks. With Amazon, we are hoping in the next coming year it could reach as high as $3,000, but as low as $1,840, and as well the median of $2,700. The thing that we talked about as a group the most is that if Amazon was to reach that 3,000 goal, we would sell it before the 2-year target goal. But we would take the loss at 2,100 or 2,000, depending on how the spike was. When we say that, we are thinking that if it reaches below 2,100 at a slow spike, we might want to wait for it to increase back up. But if it was to drop off the planet, we were just going to sell immediately before we lost any more. And especially if it went below $2,000 no matter what, we wanted to take the loss before we lost any more. With Innovative Industrial Properties, we can see in the next coming year, it could reach as high as 151 and as low as 69.50 and a median of 95. We thought together as a group that in the next year or two before graduation, that at any point, if this company with 196 shares, if it was to reach 120 or higher, that we would sell before the target rate. But if it was to reach anywhere in between or it was booming, we would wait for the down loss and then sell. If the company was to take $50, it was to get to $50 or less, that is when we would decide to sell before dropping off and losing any more money on the stock. But just like Amazon, if it was to drop at a slow rate and not just like a bullet rate, that we would wait to see if it would boom back up. Especially if states that we knew were going to legalize weed in the next month or coming months, we might want to wait and take losses until they open up and possibly boom in sales. Besides that, this is my works cited, and hopefully with that being said, you have learned a little more about why Amazon and innovative industrial properties would be great investments for a 28 score like us with a moderate aggressive average.
So the part I had was the bonds part. Due to our above average risk rating, we decided to go with high yield bonds because it's a higher risk. The pros for high yield bonds are a high return rate, of course. The value of the bond may appreciate as the time goes on, so you can sell it like in between the maturity date. And income is more dependable than stocks. Also, it takes priority over stocks during times of liquidation, which can come in handy. And the cons of it is that it has a low credit rating. They have high risk and they're more vulnerable to economic change. The first bond we chose was Diamond Hill Corp. They are ranked among the top 10 in their industry for their bond. And Morningstar is giving them a 5-star rating, meaning that they have a great return rate as it comes to their bond. Some of the important things to look at is that they have average expenses, so there's not really much to worry about, and that affecting the return rate. The turnover rate is 132%. That's good because it means that it's receivables, and the receivables are collected quickly. Their fixed assets are heavily used, and their excess inventory is very little kept on hand. The expense ratio is at 0.92%. That's almost at the ideal rating, because anywhere at 1% or over, that's not like really healthy for a bond, and you won't see much return. The timetable we use for this, we use about 5 years, because that's usually when this bond in particular starts to see a profitable return rate in dividends. The second bond is Fidelity Capital and Income. They have a 3-star Morningstar rating. They have average return rates and low expenses. Their expense ratio fits right in between the ideal expense ratio, which is between 0.50 and 0.75%. So it's looking at a good return rate of dividends for people, and the turnover rate is at 51%. That's also an ideal rate that you want to see in bonds, because it means that the different processes and assets are being managed and looked at constantly, and they're being under control. With these three, we decided to put $30,000 into bonds, and we would like to put $20,000 into Diamond Hill Corp bond and $10,000 to Fidelity, because Fidelity takes around 10 years to see like profitable returns and dividends, and Diamond Hill only takes 5. So within the 10-year difference for Fidelity Capital and Income, we could do more than like one investment in Diamond Hill Corp and see more of a profit.